Hi, this is Kelly O'Connor. We have many clients who are advised, due to their success or their self-employment status, to fund money into a qualified plan like a SEP IRA, for example. This video is to specifically go into how these accounts work. The number one reason people are advised to put funds into these accounts is because of the apparent tax savings, right? It defers the taxes. We like to use the term postpone, because that's truly what it's doing. It postpones the tax, and it also postpones the tax calculation. Now there's a couple questions we have to ask because of that. Number one, what tax bracket will you be in at retirement? And number two, what deductions will you have when you take the money? Now, the government certainly can raise taxes, or you may earn yourself into a higher bracket, and at the time later on in life when you have no home and kids are gone, you also may be out of deductions. So this type of an account, like a SEP IRA, becomes very important to dig into the math. So let's do. I want to take an actual example from a client of ours who owns an HVAC business. They have about 50 employees, a fleet of approximately 25 trucks, and they've spent the last 20 years building this business. They've got something going on, what we call concentrated risk. That means all the money is in the business. They went to their CPA, who's doing a fine job saving them some taxes, paying the least possible, maximizing deductions, etc. They went to the CPA and said, we have to start putting funds aside for our own retirement regardless of whatever happens to our business, whether we can sell it and make proceeds or not. Now, they had a couple issues because they were grossing about $1 million a year in income, so obviously they're in a high tax bracket right now, and they enjoy a pretty extreme lifestyle. 2 vacation homes, a gigantic home here in town, vehicles and toys, all the good stuff. So it's very unlikely that they're going to be in a lower tax bracket when they retire. Plus, they'll have a lot less deductions because, after all, they won't own the business anymore. It would be almost a crime for me to project them at a lower tax bracket in retirement. Now, the CPA gave them some interesting advice. His job is to save them on their taxes for this year. So he said, we can put the wife on payroll and we can max out the catch-up provisions, and we can get $42,000 a year into a SEP IRA because it will save you taxes. And he suggested that they do it. Well, one thing to make clear is they were both about 50 years old, and their goal was to be done and retired in 10 years. So they sat down with us, and we said, great, let's take a look. Now they're at a 33% federal. We'll leave the state out just for the sake of states vary, but they're at a 33% federal, and they're wanting to retire and sell the business in 10 years. Now, they were also advised by another advisor that they could be earning about 10% in mutual funds over that time. They had a lot to invest. He felt he could play the game. Well, we would definitely challenge that in of itself, but let's just go ahead and use their numbers. All right? So what this says here is when they get to retirement and the statement shows up with an account balance of $736,309, they think they have how much money? That's right, they think they have $736,309. Well, that's not really the case, because you see they haven't paid the tax on this $736,000. So when the statement shows up with this amount, that's not really their money. If they were able to take it all out in one lump sum, they owe the government 33%, a third of those funds. So their share is really worth $493,327, and the government's is worth $242,982. Now, where did this $243,000 come from? Well, over the years, this client did not pay the government the $138,600 that they deferred. Right? So let's take a look at this documentation here. So you see here they're contributing year one $42,000, right? But at a 33% tax bracket, they're deferring $13,860. So as we start to look and add these up, they've deferred $138,600 over that 10-year period of time, which is obviously, $138,60 times 10. True? So $138,600 is what they have deferred. So how did $138,600 grow to $242,982? Well, some people, even CPAs, erroneously say that by using a SEP plan, you are using the government's money. But if that were the whole truth, then you'd only owe them $138,600. But our clients don't owe them $138 because they never had $42,000 in the plan originally. They only had $28,140. You see, while their money is growing at 10%, so is the government's share of the money. A fundamental mistake people make is they think when they put 42 grand into the plan, they act like all 42 grand belongs to them. It doesn't. If they're in a 33% tax bracket, $13,860 of those dollars belongs to the government each year, and $28,140 belongs to the client. So your money is growing, and the government's money is growing as well. The proof of this is to simply change the rate of return. What if they didn't get 10% and, say, only got 6%? Well, now we don't have $493,000. We only have $393. Well, see, the government share also dropped, right? It was higher previously. What was it before? $242,900. Now it's $193,600. We still postponed the same amount of money, only now the government share didn't grow by 10%, it only grew by 6%, which is why it's not worth the other amount. It's only worth $193,600. Now, if after 10 years the government came to them and said, look, you've been putting aside the funds, but we'd like our share now, and we just want you to write us a check for the $138,600 to call it even. Well, our clients certainly would sign up for that program. And that would truly be using the government's money. But that's not the deal. So let's put this back to 10%. Now, if they're in the same tax bracket when they put it in as when they take it out, there's no difference, right? We deferred $138,600. At 10% it grew to $242,900, and the government share is $242,900. Well, what if they are somehow mystically and magically able to get themselves into a lower tax bracket? They could have paid 33 cents on the dollar, but they chose not to, and they can take it out at, let's say, 28%. Then this will be their benefit. You see, they postponed $138,600, and it grew to $242,900, but they only owe $206,167. So where'd the additional amount go? Well, it just went to their share. This is the only way where it works out to their advantage. Now, if they either earn their way to a higher tax bracket, as I mentioned earlier, or if the government simply decides they want more of their money, well, then what? Well, let's say they go to 40. They still grew to $736,309. They still deferred $138,600. Right? But the government share grew to $294. You see, the $138,600 grew at 10% to $242,900, but they get $294,000. And where did that come from? Well, that came from the client's share. So if they find themselves at a higher tax bracket in the future, it is mathematically to their disadvantage. Now here's a question they and you must be able to answer. How is it going to be possible for them to be in a lower tax bracket in retirement when they're doing and they are as successful as they are? What is their exit plan on this? Anytime we are postponing a tax at a future tax bracket, all we're doing is adding to the government share. This is so important. If you have been advised to be doing SEP IRAs and you happen to be successful and you're putting money in, well, you are setting yourself up to be transferring more money away to the government than you need to, and there are solutions. And these conversations need to be had because it can be fixed. We look forward to speaking with you.